So I think one of the things, obviously last year was such a incredible year for interest rates, where you had 2018 peaking at 3.25 on the 10-year in the U.S. and the bias that has been felt for a couple of years of saying, oh, we're going into a higher rate world, finally felt like it was happening. And then 2019, just all of that reversed. Came back and more, and sort of the volatility of rates are now collapsing. And, if you look at the long-term history of interest rates, where we are historically, you're in this unprecedented low level. And so kind of what's your view of that volatility last year, and sort of what do you think the bond market is reflecting?
So it's really interesting. Last year was a really interesting microcosm of the bond market, because it was like a two-headed investment. It was a two-headed snake in a way, because you had rates going up aggressively, and everyone was saying, okay, the U.S. is about to see a 3.5 yield treasury, or a 4% treasury. They always do this at the beginning of the year. They always overestimate the yields, and they're always mistaken, and then the yields drop. Well, we saw what happened with the trade war. We saw what happened with the weakening global economy, and it just on a dime reversed itself very nasty and very aggressively. And we were always kind of in that defensive mode for bonds, just because the risk return of being very aggressive wasn't in our favor. But at that time, you still have to be invested, and it's still a relevant asset class too. So in the end, there was a thought that at best you're going to get is a coupon yield. You actually got capital gains. You got whether it was our bond fund or the index. You're talking roughly around 6-7% rates of return from the bond market, where everyone hated it in the first quarter of 2019.
Yeah, it felt like there was a couple of years of rates being low and kind of inching up, and so from a capital gain perspective, there wasn't much. It was just the yield.
No.
But it feels like that excess return for 3 years worth of it all came in the last year on a capital gain side. But I think the one thing you said also is important is just the importance of fixed income as an asset allocation tool.
Yes.
Where you had a tougher stock market in 2018, but then having fixed income alleviated that sort of overall rate of return
even
in a tougher
even
year.
Internally, we had this discussion about how relevant are bonds for clients. Now, we know that capital preservation is foremost important, but also you want a rate of return. So in the end, we were struggling with clients who kept pushing back on saying, why do I be in the bond market if you're not going to make any money, or it's low yield environment? But at the same time, you have to balance two bonds just for that rainy day or that capital preservation. But what did change, and we had this internal discussion in Avenue, is that we always talked about, theoretically, everyone needs at retirement at least 6 to 7 years worth of bonds to cover the volatility from the equity market. So everyone's invested in the equity market. What you can't do is pull out money out of your investments if the equity market is down. So that's why there's a need for the bond market. So the debate that went on internally was, maybe that's too conservative. Maybe we don't need 6 to 7 years of bonds. Maybe it's more like 4 or 5. And that's why kind of how we left it. And that's why we had thought over the last year there was a chance for maybe lower exposure
to fixed income.
To fixed income, even though it's still a very relevant asset class. Of course, that depends on all individual circumstances.
Of course.
But going into 2020, there's been a lot of interesting stuff that you have looked through as well.
I think
some charts that you showed me, and maybe you can kind of throw it. I'll throw it back to you on 2020, but then I'll give you my kind of thoughts.
So I think the most interesting thing, if you go back and look at really dial in on some of the things that the Federal Reserve has said the last couple of meetings, of you had this really aggressive about turn by the Fed in early 2019 after they hiked in 2018 into a tough market. And then you had the 3 cuts this year, and there was, at each meeting, it was very well priced in that the Fed was going to cut.
Right.
And then the last 2 meetings, they've now been on hold. But the language around the Fed of finally realizing that, the difficulty in creating inflation, and they have this, aggressive view that they have to get inflation higher. And so this idea that you're not going to cut unless you see sustained and persistent inflation. I mean, to hear a Federal Reserve chairman say that, that is as extreme, and it didn't really get as much play.
No, that was broadly a really big thing for me, a transformational kind of moment it's always very boring, this Fed speak. You don't get much from them. Everything's more or less obvious. But I thought, and it didn't even really resonate with any of the investment community. I thought that speech where they basically said they're going to not raise rates until they see inflation sustainably above 2%.
Yeah.
And then you overlay that with the Trump administration's obsession with lower rates, and then you look at the global landscape where there's a real possibility that not only the Fed doesn't raise rates and they try to get inflation hotter. And the ingredients are there for it to get hotter. It's just I'm a little suspect on if we ever can see higher inflation, because Japan has been running this. So Japan has been running this model for 20 years to ramp up inflation. They had negative rates. They've done everything possible. The problem is with Japan, it's a society that doesn't allow immigration in.
Its aging population.
Its aging population is probably around 65. So there's a natural structural deflation embedded into Japan. So that's really not probably the greatest test case.
Yeah.
So then we move over to Europe, and they're more or less trying to do the same thing. And the trouble is their policies are so archaic and so behind, and they're so fixed.
It's crony capitalism in a lot of those economies.
So with that, it's also a hard example to kind of flow through. So the U.S. is finally probably going to enter into this kind of zone of how do we create more inflation? Because they have so much debt that they have to try to inflate their way out.
I think that's the psychological thing that's happened. I think they haven't expressed it, this directly, but I think they realize that you have to be at a point where your real yields or real interest rates are at or close to zero, because that's the only way that you're slowly defacing the value of the currency.
Right.
This idea of I think the view a couple of years ago was that you were in this better growth environment. You're going to go to positive real yields, and it seems like the economy couldn't take it for more than a couple quarters of actual positive real yields. And then all of a sudden, we come back down to what is basically a zero real yield, and that's a way that they can debase, this massive amount of debt.
And if you look at, going back, if you look at the ingredients of inflation, like I said, those couple of prior examples weren't the best case scenarios because they had individual or they had country specific issues.
Yeah.
But if you look at the U.S., we have full employment, we have easy monetary policy. And we have capital spending or infrastructure spending.
Yeah.
So the economy is, and most importantly, the consumer is incredibly healthy.
Yeah.
So generally what happens in recessions is you're trying to save the consumer because the consumer has high unemployment rate. Consumer is restructuring, they're bankrupt or they're over-levered.
Yeah.
Well, that's not happening in the U.S. We have savings rates of now around 6-7%, which is huge in the U.S. The consumer is 70% of the economy, and now you're juicing up the system.
Yeah.
So I'm not gonna. I have conviction on this idea, but I'm not gonna go all in. And what I mean by that is I still don't know if we can see inflation again because it's failed. Structural inflation.
Yeah.
But this will be an interesting time because with the Fed on hold, you're going to have this fire. Even this enhanced fire pushing onto the consumer because they're already hot. This might be the chance. And another thing is this is the first year I can ever remember that all the strategists and the economists, they've always said higher treasury rates every year at the beginning of the year. 3%, 4%, 5%. They've always talked about this and they've always been wrong, other than maybe 1 year in 2016 or something like that, or 2017. But what's interesting is now everyone's so used to that they all think rates are going down.
Yeah, I think
so that's anecdotal. There's no proof to that.
It gives you
but
contrarian
as a contrarian
view, how people view
you're
our
also
position.
given something on a contrarian view that this might be the year that they get it wrong and then rates do climb higher.
Yeah.
And when I say rates climbing higher, I don't think it won't be substantial. But then at the same time, as I say, it might not be substantial. It might be big because if we do see inflation, then what do you think the bond market is going to do? It's going to react violently to that because the bond market has never believed in the equity market's inflation story. The bond market has always thought there's massive disinflation in the global economy. But this might, if we did see a whiff of inflation, then you actually might get the bond market to really adjust. And what does that mean? You see the yield curve go up, and you also see the yield curve steepen. So what one of the biggest positives of the bond market over the last 10 years has been is the long bond rates, long-term bond rates, 10 years and higher. Well, that might reverse itself because you're going to get a steepened yield curve, and then you're going to suffer price losses. So where do we end? So the question is then, what do we do with 2020?
Yeah.
So we go into it no different than really last year. Always trying to get duration up. Because we're always struggling with duration, because we tend to be short-term buyers of corporate credit, and we can kind of go into the credit markets after this because there's a dynamic there that's really strange that you've talked
we can talk
about
about that a little bit.
But the fact is that we're going to be slightly conservative and slightly negative to duration. So in getting ready for that possibility of higher rates.
Right.
I'm not going to, like I said, put all my money on black on this idea, but I just need a little more proof because the ingredients are there for this to play out. But that being said, my forecast is this year you'll probably just get a coupon return of maybe 3%.
Yeah,
and I don't think much more.
I think it's interesting, like sort of, now having worked with you for a number of years and sort of always trying to see and feel what you're thinking. But the one thing you touched on, which was for years, everyone said the market and, forecasters all said rates were going higher every year. It was the same drumbeat in January. Yeah. And I totally agree with you to see it have reversed of now everyone is saying, well, rates are going to maybe be here or lower, that it shows you the shift in market sentiment. And I have not seen a year like mispositioned like this, where you do have that now view that rates going higher is a contrarian call or slightly contrarian. And it just shows you that if you do have, to your point, inflation, just expectations change a little bit, or you get oil higher, or you have this cyclical growth recover, there's no reason why, the long end can't steepen 50 basis points or a percent. And then at that point, a lot of the views that are being expressed now are offside about this, rates are going to collapse lower. Because, the other thing we didn't really touch on yet is this idea that not only is the Fed easy and keeping rates low, you're still pumping $1 trillion of new deficit spending into the economy in the U.S. this year. So you've got the consumer that's in good shape, you have the Fed that's easy, and you're still massively expanding on the fiscal side. Yeah. By 5% of GDP again this year is going to be the deficit. So this idea of you're running incredibly stimulative policy when you have inflation or you have unemployment at 3.5%. And a basically full economy, you'd have to go back 50 years to see this kind of an aggressive policy. And I think a lot of that speaks to also the sort of political, divide we're at, where everyone wants to take credit for all the good things and the bad stuff is everyone else's fault. But the Fed now this year had to start re-expanding their balance sheet because all this excess issuance from the Treasury was basically bloating the balance sheets of all the broker dealers, and now the Fed has had to step in the T-bill market.
Yeah, that's
and
a really
the repo
good point.
market. So
you could talk to the audience about explaining that dynamic. What happened in November? Was it November?
Yeah, no, September. So September. Yeah, so what happened in September? It was actually September 17th. Was that you had in the overnight rate market, which is
the funding market for all these banks of the world, of the U.S. banks.
So basically, it's the cash market for overnight lending, and you had rates very quickly spike up to, I think they topped out around 10% overnight. So which means for one day money, interest rates were 10%, which just shows you the Fed had been on this program of decreasing the size of their balance sheet, pulling liquidity from the system, quantitative tightening is what they called it. And you hit this sort of mini crisis point in September where all of a sudden there wasn't enough cash in the system. And so you had short rates spike because of that. And so the Fed was very quickly on the case with regards to that. And a week later started doing repo, expanding their balance sheet with T-bill purchases. But the amount of liquidity that the Fed supplied, if you wanted to pick the day the S&P bottomed in October and was on a hockey stick into the end of the year, it was on the day that the Fed basically came out and said, we're going to be expanding our balance sheet again.
Yeah, and that's really telling because, in regards to that overnight issue, it's a technical issue. Basically, there's just too many bonds chasing.
Not enough dollar bills.
Dollar
like cash.
bills.
Yeah.
So I've seen this historically where, of course, during the fall of every year, some point there are liquidity issues, but this only lasts for a week, for 3 days, for 4 days.
Yeah.
This seems to be permanent. And that kind of leads me, once again, another piece of the ingredient is you have systemic debt issuance in the U.S. that's not turning around, and it's probably going to get worse. Because if you do have a recession, the deficit's going to $2 trillion.
Yeah.
So which is it's not sustainable. It's only sustainable until it isn't. And we've always said that you can never pick the day that you don't buy another U.S. Treasury bond, but there will be a day, if it keeps going like this, there will be a day, and I don't know if that's 2 years, I don't know if that's 5 years or 10 years, but there will be a day where you just go, I'm bid out.
I think the other thing that's interesting, like that ties into this, is that if you look at how the current administration has weaponized the U.S. dollar in tariffs and globally, they're sort of running economic sanctions against the world and using the dollar's strength to do that. But the one thing that's really changed the last couple of years, if you look at the issuance of T-bills or treasury bills that are being bought by foreigners, so foreign governments, foreign central banks, that's now collapsed to really low levels. So you have, at the same time, these massive deficits. Foreign governments and foreign central banks aren't buying your paper anymore.
Right.
And so that's where the Fed has had to come step in and be buyers of T-bills. They said originally it was a year-end tax problem and it was going to be a week. They've been buying $5 billion of T-bills every day for 3 months.
Yes.
And so you tell
they're caught in this situation.
Yeah, so I think I give them credit.
Maybe we could talk about the dollar a bit right now. So that's a flow through into the dollar conversation that you have a Trump administration, you have the Federal Reserve, and you have the dynamic of the economy, global economy, which is good growth, not great growth. Gives you the ingredients that the sundry currencies or the emerging markets or the non-U.S. led currencies such as Canada or Australia or Europe, all slightly doing better in December, and they're kind of breaking technical levels that we haven't seen for a while. And it's set up for a very bullish run in non-U.S. currencies. Well, non-U.S. anything against the U.S. Seems to be doing better.
Yeah, I think this,
and then of course gold. Of course, overlay gold is once again another ingredient on why we think that, and we've talked about this over the last several weeks, that the U.S. dollar is vulnerable, really vulnerable, over the next 2 years.
Yeah, I think for the last couple of years, it kind of felt like you were entering this period on the policy level where things were setting up for a weaker U.S. dollar, but then you had this period where it was still a better growth environment in the U.S. versus globally. You had the U.S. stock market ripping, buybacks, all this stuff. So all of that sort of forced dollars into the U.S. system, and so you sort of were strengthened with the U.S. dollar because of that. But it feels like all of those things now are kind of like going back the other way. You're having better global growth. Europe looks a little bit better. Emerging markets look better. Asia looks better. You had at least a trade truce, whether this phase one deal is it anything at all, but this kind of risk on sentiment that's changed has now, and at the same time the deficit's exploding. And people's like the sustainability of the strength of the US dollar I think is really starting to crack, and I think that all you need is the Fed to continue easing or there to be more expansion of the balance sheet, things that aren't priced in, for that to change. I think the other thing that I think would be interesting to talk about is just you've now had 5 years of negative interest rates in Europe. So you had a change in the ECB recently with Christine Lagarde, and this sort of negative Europe view and the negative Euro view for so long that have really allowed the US dollar to maintain its strength. But the one thing that's interesting is that the Swedish central bank, which was the first to go negative in 2014, actually now basically said, this isn't working anymore. We're going to take our rates back to zero and be done with it. And you've had for the first time a really significant strengthening in the Swedish currency krona against the US dollar. And all of that is just saying we're no longer negative, we're going back to zero, but it shows you how much pessimism was built into these other currencies. And so, what is your view now on what the euro looks like and this shifting winds of central banking in Europe? And do you think that there's a chance that even if the euro ECB says we're going back to zero, things aren't great, but we're going back to zero because negative interest rates don't work, that you could have this kind of whiplash in the bond market, maybe in Europe, about where you have still all this debt that's trading at negative yields?
have less conviction on the euro, because the euro would generally go stronger, and it probably will. But there's so many structural issues and so many political issues in Europe. But if we kind of take that same thought process and put it upon Canada, let's use Canada, because of course Canada is also, we are way more exposed to Canada because that's our portfolio and how we manage money. But let's talk Canada, and you could make the case that Canada could be really strong over the next 2 years. Let's go through this. So you have even, oil prices have gone up recently, and they haven't gone up as much as you would think they've gone up, considering all the geopolitical events that's happened over the last 2 years, 2 weeks. So that's positive. Relative budget deficits, as much as we can cry about the liberal deficits that are happening and that are about to happen, they're still within the spectrum of normalcy or a spectrum of relative to other countries.
Like rational.
You're talking 1% deficit to GDP on Canada. You're talking in the U.S. At least 4%, if not 6%.
Yeah, the true numbers.
So that's one. Two, the economy is generally decent here, and never forget that immigration in the Canada, which we generally like, adds about 1% of GDP growth just by all the immigrants coming in here. So it's a net positive to the economy, because demographically we're in the same situation as Japan or most other countries. We're not having enough babies. So by that default, we need to have immigration come in, because we have almost full employment.
And it's been a huge boost. I think Canada is seen as a country in the world where a lot of people want to come to if you're coming from other countries. And it's really been a huge boost to growth the last number of years, especially the GTA and Canada.